Here's how my £18,500 investment portfolio performed in February 2026. In this video, I'm going to go through every holding, what's moved during last month, some of the news and some of the context behind those price changes. But as always, this is the compounding project. Thank you very much for clicking on this video. If you enjoy it in any way or find it interesting, please do hit that subscribe button. I'd be very grateful for the support. So if you're new around here, I'm a long-term investor. I'm in my early to mid 30s, and this video should definitely not be considered to be financial advice. You should absolutely do your own research, because I'm just documenting what I'm doing with my own real money with a circa 20-year time horizon in mind for when I'm hoping to be able to use the money to give me more options later in life. And at the end of February, my portfolio is sitting at around £18,500. As a whole, it's up around £428 or roughly 2.4%, and I've added £800 of new money. I'll show you what I've bought though later in the video. Let's go through the holdings then, starting with my biggest holding, the FTSE All-World Index. Now, this massive index fund gives me exposure to around 2,500 companies globally, so it's very diversified, and although nothing in life is guaranteed, in theory, this fund is low risk. The fee for it is quite low, that's 0.19%, that part is not theory at least, and it's on the lower end of fund fees, so it's very appealing to me as a long-term investor. The FTSE All-World Fund itself was up around 3% this month, or around £200, which I don't think is to be sniffed at all, and it just shows that globally markets have been steadily drifting higher. There's a lot of headlines around. If you look at the financial tab on any news website, there's AI optimism, there's continued strength in large global companies, but I'm not buying this because of any of those things, or because there's momentum in the market or the market's looking strong. I only really look at those sorts of news things to keep myself interested in the space of stocks and shares. I plan to keep buying this index fund regardless of what's happening in the news or even how it's performing. So I guess it's all just background noise, but I find it interesting, and I'm going to come back to this fund in a bit more detail later on in this video. Next up is the S&P 500. Now, this index fund is the biggest 500 companies in the USA. So although it's diversified, it's not anywhere near as diversified as the All-World Index Fund. The performance for this fund this month was a bit lower. It was about 0.8% or around £50 in total. There's absolutely loads of things in the news. If you look at anything in America, tariffs, tech, oil, and so on. So similar to the FTSE All-World story, I'm trying not to absorb any of that, to be honest. I just think the sheer volume of things that I see makes me more cautious. So if anything, it makes me not want to put money in. But that being said, I'm trying just to push that to one side, and it's been quieter in terms of growth this year and definitely this month compared to global markets. But looking at the graph overall for the last month, it's been all over the place. And if I'd have made this video a week ago or 2 weeks ago, it could have been a completely different story. So I'm just trying to remind myself that this month, when I zoom out in 20 years time, it's going to be a tiny little dot on hopefully a massive line graph that goes up. So regardless of whether it goes up or down or sideways, I still just need to keep putting money in. So the first bit of red in this monthly update is my Google stock, and it is down about 8% or £130 in my case. And as has been the case for the last few months, there's been loads of talk online about AI competition and companies changing expectations about valuations and how much money they're going to make. And that just means that the short-term volatility of Google and companies like that have just been up and down. And this is across most of big tech, not just Google. Now, looking at the stock as a whole in my holding, I'm so far in the green that I don't really care too much about the month-to-month fluctuations. I'm up about 70% since I bought the stock at the beginning of 2025, and I'm not buying any dips. I'm not looking to add any more money to it. I think this is actually a really good test for me to see the information, see the stock dipping, have an emotional reaction mentally, but actually not do anything from that. When I bought the stock, it was absolutely an emotional decision. I'm just a big fan of the platform of YouTube, so I thought, yeah, okay, I'll buy some YouTube stock, why not? One red month doesn't and shouldn't change my 20-year plan though. I'd much rather work on this sort of behavior and discipline at this early stage rather now than in hopefully 10, 15, however many years time, when hopefully the numbers I'm talking about are a lot bigger. You might have noticed that I'm using the platform Trading 212, and if you're looking to start your investing journey, I have a link in the description down below. If you use that and sign up to Trading 212, we'll both get a free fractional share. I'm actually pretty interested in what the uptake of this is, because as somebody who consumes lots of finance content, I see all the finance creators saying this. I don't know what it actually means. So my commitment to you is that I will share the outcome of this sort sorts of things on this channel transparently in future. So thank you very much for your support. On the flip side to Google though, good old Rolls-Royce had a really strong month, up around 10% or £200 for me. This is largely due to an earnings report that was released in February. It reported a 40% jump in annual profit, which is obviously going to have an impact on the stock value, with an underlying operating profit of around 3.46 billion, which sounds very comfortable, and strong free cash flow, which was far ahead of their expectations. They also upgraded their medium-term targets and said that they expect profits to keep growing over the next few years. So very encouraging, great headlines to read, but I'm aware that is all just news. I'm not buying the big headline or something that's piqued my interest. The main thing that, if anything, did stand out to me was the share buyback program. So Rolls-Royce, I didn't know what that meant when I first saw it, but they're basically using their own money to buy back its own shares from the market. So something like £7 to £9 billion worth. So I think my couple of £1,000 is safe. But between 2026 and 2028, they're going to be doing that with about £2.5 billion of that planned in just this year. So when a company buys back shares from the market, those shares usually get cancelled. So fewer shares exist overall. You can't buy them. And that means that if there's fewer shares available, then each remaining shareholder owns a slightly bigger piece of the pie of the company. So in theory, earnings per share can increase, so the dividends that I receive from my Rolls-Royce shares will increase. Not a particularly high-paying share dividend at the minute, but this looks like it could increase, and it can support the share price over time as well, because of course there are less available. So it's basically a way of returning cash to shareholders like myself without paying it all out as dividends, because in theory it's going to grow. Yes, please. Thank you very much, Rolls-Royce. Now, I'm not buying more or cashing out or doing anything from this news, simply remaining interested in it and just everything I've already talked about. I'm just using it as a bit of a mental test to almost test myself that I'm reading these things and seeing these things and then doing absolutely nothing. Seeing my individual stocks move more than the index funds just reinforces why I am now and continually going to be graduating more towards broader diversification long term. As those big swings we've just seen, got a perfect example, Google's down 8%, Rolls-Royce is up 10, they could be so much bigger and both in the negative. So great to see right now, but it doesn't change my long-term strategy. So at the beginning of this year, I also bought 2 individual stocks as part of a dividend sleeve experiment. So 2 companies which I thought were going to pay bigger dividends, just as a bit of a test. My plan for these is I'm just going to leave them for the entirety of 2026. I'm going to assess the performance as I go, and then at the end of this year, decide if dividend stocks are something that I either want to focus on more in the future or sell and put back into index funds or something. The first one I bought was Procter & Gamble, and they make lots of everyday life products, so washing powder, toothpaste, shower gel, things like that. And I bought this company in the hope that, or so I read, that it's more resistant to like consumer financial pressures. So as the economy goes up and down, people have more and less money to spend. Their sales should remain similar because people often buy these things as like daily essentials. They have had a strong month. They're up around 13% or £42. So similar to Rolls-Royce, they had a good quarterly earnings report released. It's good to hear and see. It wasn't part of my plan. I thought they'd just sort of flatline, but it does also again remind me that if the numbers had gone the other way, then my holding would have gone the other way too. So good results, but I'm almost a bit hesitant to celebrate. The second dividend stock that I bought was Legal & General. You might have heard of them. They sell life insurance, pensions, annuities, lifetime mortgages and all sorts. They were up around 2.5% in February, or £21 to me, and UK financials have held up fairly well recently, partly due to stable earnings expectations, relatively strong dividend yields compared to other global financial institutions. L&G sound a bit similar to myself, a bit boring and a bit predictable, but that is absolutely fine. And again, that's a theme you're going to hear a lot on this channel. And again, I'm not going to be changing my strategy because of short-term moves or short-term headlines. So this is just like context. It's not a trigger for me to act. Although I'm of course happy to see that these again have increased in value and not red, it doesn't actually change anything I do. If anything, it makes me a little bit more cautious. Now, I've not had any dividends from either yet. When I do, I think I'll cover them in a separate video. So I don't actually know when they're paid, to be honest. I just sort of bought them. I thought I'll figure it out as I go along, as the theme of the channel. I'll keep an eye out for that payday and I'll let you know when it lands. New money then, what have I been buying? So this month I bought another £800, but just of the FTSE All-World index. Now this forms part of the bigger shift in where I want the majority of my portfolio to be. I wanted the majority of it to be there when I started, but as I covered in my previous videos, it just sort of ended up that I got interested in individual stocks and they rose loads. That's not the strategy. My plan is to put the majority of my money into an All-World index. Now, I'm such a long way away from using this money that it almost doesn't matter at the minute. What I need to build in is the habits and behaviors that I put money into the global indexes rather than the individual funds. So it doesn't matter right now that I think I'm sort of like 75% index funds. Yes, I want to get it up to 90, 95%, but I'm not panicking that it's in that situation now. So what I'm actually going to be doing is, rather than selling any individual holdings, I'm going to work on my behaviors and habits and put new money into those index funds. So FTSE All-World, S&P 500, and just build that up so that it increases the percentage without me selling anything else, I think. For me, this is about making the portfolio a bit simpler, to require little to no thought or stress. That's a big factor of mine. And hopefully, although I do know it is absolutely not guaranteed, to be more consistent in terms of returns and growth over time. The goal with this, unfortunately, isn't to be exciting for YouTube videos. It's to be boring, to steadily compound, and to hopefully give me more options in later life, which will be more exciting than a YouTube video. So overall, a pretty good month. I think the portfolio being up just over £400 or 2.5% is nice, but it doesn't really change anything in a practical sense. What it does change though is it keeps me mentally motivated. So it keeps me investing because I'm seeing the numbers go in the right direction. It makes me want to put more money in and be more involved. I shouldn't change my actual numbers, but motivation-wise it does. One of the weird parts right now is though, and it's been the case since I started investing at the beginning of 2025, is just seeing markets either close to or at an all-time high every time I buy. It feels uncomfortable to think, oh, I could be buying right at the top, but I guess that's just part of long-term investing. If you wait for everything to feel cheap or perfect, you probably just never invest. I remember 10 years or so ago when my partner and I were thinking about buying our first property, I did on and on about, oh, should we leave it a year or two for maybe prices to come down or something, or interest rates to drop, and yeah, we all know how that went. So looking ahead to March, my focus is simple. I'm not going to be changing anything, but I will be giving thought to what I want to buy next month, so I'm prepared for it. I do seem, looking back at my investments, to be a bit all or nothing with my contribution. So am I buying all of one thing or all of something else? I think what I need to do is be a bit better about breaking up that money and buying a few different things in the same month. So while staying consistent with my goals, I think I need to be a bit more flexible. It might have been that this month might have been a good time to buy S&P 500. It might be that I should actually, if I'm investing £800 a month, put 700 into the All-World index and 100 into individual stocks. I don't know, but I think I need to be a bit more adaptable so that I'm not just all or nothing. But I still stand by the most important thing being me just putting money in the market, and where exactly it goes, if it's in one index fund over another, I don't think that makes too much difference at this stage of my journey. So like I said earlier, over a 20-year time horizon, none of these monthly movements really matter, but showing up each month, being interested in the progress, relentlessly and consistently investing and building that habit, that's the real compounding happening right now up here. Let me know how your portfolios did this month, and I'll see you in the next update. Thanks for watching.